Hey guys, thanks for tuning in. The purpose of this video, the topic of this video is to discuss the types of investment that are available to investors. As you can see, I've actually classified it in three categories, broad categories. This is the first category that we will discuss in this video is stocks. We also have the bonds and the alternative investments category. Now, the stocks and bonds is usually referred to as the traditional types of investments. So those are the type of investments that have been traditionally used by mutual funds or individual investors. Now, what exactly is a stock? A stock is basically just a certificate of ownership or part ownership of a company. It's just it used to be a piece of paper that was sent to the owner just to say, okay, Mr. X or Mrs. Y, now you own one share of the company. The company might have 10,000 shares. The company might have 100 shares, and you would own one share of that company. In which case, you are an owner. 1%, you own 1% of the company. If the company has 100 shares and you own one share, you own 1% of that company. That's just grossly what it could be. Now I've represented the just to actually make it very obvious for you. Just imagine that the company is actually a pizza. I've sliced that pizza. I've actually designed drew 10 slices for the inner circle, just to say that basically when this pizza started, it had 10 slices. Okay, so let's say that as a business owner, I start my company. My company is basically a pizza, and because you invested in my company, I give you one slice of pizza, which will represent one stock of my company. So in other words, it's almost like my company has 10 stocks, and I give you one stock of my company, which means that you own 10% of my company. Now, I might keep 5 shares for myself because I want to keep control of my company, and all the other investors, you and 4 other people, would get 5 shares total. Now, there's two ways that you can make money with a stock. The first one is called dividend yield, which is basically a profit redistribution uh, proportionally to the share, the percentage share that you have of the company. So let's see how it works. Let's say that I started that company, you invested in my company, and you bought one share, which represents one slice of the pizza. Now, turns out, when I actually, after my financial statement, you can see after let's say 1 year. After 1 year, I've declared the profit of $10,000. Now, if you own 10% of my company, you're also entitled to 10% of the profits. In which case, if I were to redistribute totally what I've gained, I'm not considering any tax, I'm not considering anything. Now, this is now just gross numbers. If I make $10,000 of profits and I redistribute totally what I've made as a profit, if you own 10% of my company, you're entitled to 10% of the profit, which would mean $1,000 for you. Now, in reality, there is tax considerations, and also usually companies don't just give out all the profit that they've made. They might have some ideas that they want to invest in. They might have some treasury considerations where they would like to keep more money in case there is an opportunity that comes in, or in case they have some litigation cases, or whatever they will need the money for. So in reality, they will just redistribute part of the profits that they've made, but the basic logic is the same. You would receive an amount that is proportional to the number of shares of the company that you own. Another way for you to make money with the stocks is through capital gain. And how capital gain works basically is very simple. It just means that your stock has appreciated over time. And now you are able, if you'd like to sell it at a higher price than the price that you've bought it for. So let's actually see how it works. So let's say that on January 1st, you bought the stock at $5. And on March 1st, your stock is worth $7. Now, not considering the time value of money, it would mean that you've made $2 per share or per stock if you want. Okay, and so now that represents the outer circle that I've drawn here, which means that now for everybody, the pizza just drew larger. Remember, at the beginning we had 10 slices for the inner circle, and if each slice is worth $5, when you have now on March 1st, each slice worth $7, it just makes sense that the pizza will be larger. So all the owners of the company now have assets that are worth more because of the increase in the price of the stock. Now, like I said, you can decide whether or not to sell the that amount, that profit, that the stock, and actually cash in on the price increase. If you do decide to cash in on the price increase, it is called realizing your gain. If you don't decide to cash in on that profit, maybe because you expect the stock to actually grow even more, which means the pizza to grow even larger, who wouldn't want a large pizza, right? So if you decide to keep the pizza, to keep the stock and not to sell your shares, you still have made the $2 gain, but now that gain is unrealized because you haven't cashed in on it, and because maybe you expect it to grow even further. So just to recap what we've just said, a stock is basically just a certificate of ownership or part ownership of a company. There is two ways that you can make money with a stock. First is through the dividend yield, which is the return that you would get from the profit redistribution from the company, and that is proportional to the share or the part of the company that you own. And the second way is through capital gains, which is basically just to say that the price of the stock has appreciated in value over time, and now your asset, which is a stock, is worth more. In the next video, we will discuss the bonds. It's another type of traditional investment, and we will cover that in the next video. See you guys.